Good morning and welcome to Radio Kidnappers and Money Talks. This is Stephen Diedrichs from Taxile Limited, your local accounting and tax advisory business here in Hastings and also throughout New Zealand. And here Ken mentioned I look very accountant-like with my blue shirt and grey top today. So hopefully the talk will be inspiring to you. This morning we're going to be talking about value and money, and how people place value on money, and how money has changed over time. And really it's changed not because of money, but it's changed because of value and the value that we've placed on things. When I first started looking at this, I thought, geez, it could go in any direction. And as I was making my notes and thinking about my notes, I thought about things I hadn't written. So it's a vast area where you can go on to. So just over time, people change, and as people change, the values change, and it's more important our value and how we treat money through our lives than what we end up with when we die, because when we die, it's all a reflection of our values and our values attributed to money over time. Just I put value before money, and then also talk about death, which is a bit morbid, but I just want to digress on the death thing, because that's it's actually extremely important. And I referred to something I heard Muhammad Ali say once, and he spoke about time and the value of time. And I'll reiterate his example that he used, and I hope I do it justice. If you're about say 50 years old, you think you're still going to live another 30 years. So then you've got another 30 years to achieve your dreams and goals. But when you equate that 30 years down, it actually to achieve your dreams and goals, it's actually more like 5 years. And I'll just break that down for you. So over 30 years, there's 365 days in a year. So it's about 11,000 days that you have, and with 24 hours in a day, that gives you over the 30 years about 263,000 hours. So that sounds like a lot, and you think, geez, yes, I can achieve my dreams and goals then. But then when you break it down, we sleep for about 8 hours, we work for another 8 hours. Then there's 2 hours of traveling to and from work, doing groceries, taking the kids to school, or there's the school activities, and so that 2 hours is very conservative, but we leave it at 2. And then there's 2 hours of entertainment, watching television. So if you add up, that's 8 for sleeping, 8 for working, 2 for errands, and 2 for TV. It's 20 hours. So you basically looking at over that 30 years, that equates to about 220,000 hours that you can account for. So if you have 263,000 hours, and what you're going to do for 220,000 hours, you left with about 43,000 hours. So it's really not that much. And if you go down further, that works out to about 1,800 days. So if you think over 30 years, you had 11,000 days, but now to achieve your dreams and goals is only 1,800. And that comes down to your 5 years that you have to achieve your dreams and goals. So if you look at it, it's really not that much time that you have. And if we haven't done much in the past 40, 50 years that we've been around, knowing that we really have about 5 years, it hopefully gives us a bit of a wake-up call on that point. So so just the value and how you place your value and putting value on your time, it's an important thing. So I think a contributing factor to how we've come to the point where it's over 50 years we haven't done anything is, I think we've become standardized in the way that we do things. And a typical example of this is last October, I went into a coffee shop and a lady told me, I've got 9 more paydays to Christmas. And I thought, wow, that her money story and the value story is based on she's got 9 days before Christmas to the money that she's going to have. And someone else may think, 9 more weeks to Christmas, I'll be seeing more of my family, and I can spend time with my friends, and we can do things together. And that'd be a different way of seeing things. But because of being standardized with knowing that there's 9 paydays to Christmas, her thinking was just on money. So we haven't just landed there. It's kind of drilled into us from the time we were 2 years old. Many of us would remember we've been saying, no, you can't do this, no, you can't do that. We've gone to school, high school, college, or university, and again we've been told what we have to do, when we have to do it, and how we have to do things. So that's part of our standardization. And we finished school and we thought, we're adults, I'm an adult now, I can do what I want to. But really, when you sit down and think about it, we've gone to work, and nothing wrong with going to work. That it's a good thing. If that's what you want to do, it's a great thing. But when you go to work, you are told what to do, how to do it, when to do it, when to have your lunch, what time to be in, what time to leave. So you're still in that standardized mold because you've been told what to do. So if you want to change that, then there's absolutely nothing wrong with knowing, okay, between 8 and 6, I'm going to be in this mold where I've got to do what I've been told. But after 6 o'clock, you can then just move on and do the things that you want to, the things that you value. So I guess I've digressed a bit from from value, and Kenneth's smiling at me there. But let's just get back onto the value part. And now, just a lot of what we value is also based on trust. And if we trust someone, we'll get something done a lot quicker, and it will save us a lot of time. And I'll give an example of I read somewhere that Warren Buffett completed a transaction in a short amount of time because he had trust with the people that he was working with and on his executives. So that because he had that trust, he saved a lot of time and cost in say legal fees and doing due diligence and accounting fees and fees on valuations. So that created a lot of trust. Now you may think, yes, but that's big business, and I'm just in a smaller business or running my day-to-day life. How does that really equate? So it equates in your trust in that. I'll give you a couple examples. I was called on to do a valuation of a small business, and the reason I was called on is because 2 people were separating, and they had lost the trust in them, and they couldn't determine the value because there was no trust. So if over time the way you live and how you value things and treat people, if that affects the value that you place on things, and you can't agree with people, you have to know that outside forces is going to come in and force a value on you. So I'll explain that. The outside forces in this particular case, where the couple couldn't agree, was I was asked by a barrister to do a value. So these people had a business, they didn't know me, but I came in and I determined for them what their value was. So because they didn't have any trust, they had to expend money to pay me, someone they didn't know, and I imposed the value as to what I thought the value of the business was. So I imposed that value on them. Then, taking that further, the matter went through to the court system, and the court decided, yes, that's the value, and person A had to pay person B whatever the value was. But the point is that over time and people's values and things, they changed, and because there was no trust, if you don't have that trust and you can't determine a value between yourselves, outside forces will come in and impose it on you. So it's better to determine the value and look at your past and the way you look at money and value, so that you can determine your own value for your own your own transactions rather than have someone else come in and impose it on you. So we'll talk about things that are that relate to people's houses, because most people think of value like that. So if you let's see, if you look at buying a property, for example, there'll be a bartering that goes on. So these days we try to be sophisticated and we call it, we negotiate the value, but in effect we're bartering the same way we bartered on value back in the days when when you exchanged carrots for eggs. It was still a barter, and it was more determined. The value was placed on the eggs or the carrots by how much, say, carrots or eggs the person wanted. So that was the value, and that was money as well. So over time, money changed, and as most of us know, we went from eggs and carrots to coins, and then to paper notes, because they were easy to carry around. So if you just look at that, just our value of money again changed over time, not because we didn't see coins as valuable. We just saw that we placed more value on having to carry it around, and the safety of carrying it around. We placed more value on the safety, so we went to paper notes. And the same can be said for our key cards. These days most people use EFTPOS, and again, it's easier to use EFTPOS, but subconsciously behind us we've changed our value to safety more, so that we don't want to carry a couple of $100 in our pocket to go do our groceries. We value safety more. So that's just how money's come in. And you can take that further. Since the global financial crisis, people are a bit wary about keeping money in banks, because they don't know if they can get it out if there's another financial crisis. So that's partly brought about things like cryptocurrency. So our money has changed, but it's still money. It's just the value where we place our value. We don't so much place the value that we had in banks has decreased to the point that we now place more of our funds into things like cryptocurrencies. So that's how our value changes over time. And if you look at property, for example, you may go into to buy a property, and you look at the property, walk around, look at the market, what the price is, the list price is, and then you'll put in your offer, and the vendor will accept or not. But at the end of the day, you'll negotiate or barter, and then you'll come up with a value, and you'll make the payment. So before, payment was made in cash, but now it's basically just numbers that's created on a computer screen, and that's how the property will transfer on that value. Now there's also other ways you can do that, and that's based on how you see the value. When you do a straight property purchase, right, which is like I explained, the value, and you buy the property, and you get money from the bank doesn't really place the value on the property. The bank gives you credit and values the purchaser, because they know the purchaser can pay the money back. So the value is in you, the person, and your credibility that you've created with the bank. And sometimes, well, in most cases, people would have saved a deposit. So the bank feels that, yes, you can do regular savings, so you have more credibility, and that's how the bank values you more than they value the property, because they don't want to own the property. They want the money from you. So that's where the value lies. It doesn't lie so much in the property. Now there's other ways of doing this. For example, people may have heard of vendor finance, and that's where if in effect you pay the purchaser, and you can't get a loan from the bank because the bank doesn't value you. Right, so just keep that in mind. It's important. The bank doesn't value you at that point. But if you've saved up some money, you can give it to the vendor, and you make payments to the vendor, and after a couple of years you would have built up some sort of some amount of equity or value in the property, and then you could approach a bank, and then at that point they may be open to you and then place a value on you, because you've shifted your value. You've made yourself more valuable to the bank by gaining some equity in property. So that's a way you can also, get into property and also gain value for yourself. Another way of doing this is I've been doing it a lot in Europe. I know UFNA, he sold his property this way, and that's where people have their homes. They've worked, they've spent their lives turning the house into their home, and that's a big feat. And as they're getting closer to retirement, a lot of people in New Zealand, they downsize and they go to a retirement home. But you may not want to do that. So because you've made it your home, you don't want to shift. It's a big job shifting and into a new area, and you may have to make new friends. You don't really want to do that. So another way of where value shifts is that you may think, yes, my home is worth $1 million and that's the value that I have in it. But as you become older, your value changes. So your value is now like, look, I know my house is worth $1 million, but for example, I may take 500,000 if you let me stay in the house until I die. So now you've shifted your value from the $1 million, and over time you're not so much interested in the money. Yes, you'd like half $500,000 so you can still have some money to live comfortably in your retirement, but you also value more the fact that you can stay in your home until you pass on, and once you pass on, the buyer then basically just steps in and takes the property. From the buyer's point, they could pay $500,000 instead of the $1 million, and they just have to wait until you eventually move on to the next world or die in effect. So that's just ways that values have shifted over time, and I mentioned moving into a retirement home, and with that, I just want to go back to being standardized, and I think it's actually quite funny. Although I shouldn't really make a joke of it, because there's nothing wrong with moving into a retirement home. But this is the bit that I find that's a bit funny, is that we've grown up and we've worked all our life, and we've worked hard to save a deposit. We've bought a house, taken us months to find that house, beaten people at auctions and everywhere, and then we've gone to work every day. We've put up with nonsense from our other from our bosses and other staff members, and we've put up with the stress of traveling and all that, and to turn our house and to keep our house and to turn it into a home, we may have, say, on average, we've earned $70,000 a year, say, just on average. And then we get to our retirement age and we figure, yep, the government's going to give us a pension. If we're lucky enough, there'll still be a pension for us, but they just say the government's going to give us a pension. Then at that point, right, so we had our value, and our value was to keep our house and to turn our house into a home and make it really nice for our families and everything. Then our value suddenly changed, and we valued the pension more. So all of a sudden we were happy from earning $70,000 a year, and we then saw ourselves as, we can only live within our means of a pension. So all of a sudden we've changed our value, and we've become standardized in that thinking, instead of thinking differently as to how we can maintain that $70,000 or even more. And another way that so this is where many people sell their property and move into a retirement home, and nothing wrong with that. And, it's great if people want to do that. But it's just, you've worked all your life to put up, to create that home, and then to just give it up and to accept a lower value. And so over time, as you got older, your value has changed, and your value is now you in a retirement home and you live on a pension. So this is just one of the other ways that we have become standardized. So I think it's important to recognize all these things and keep in mind that there's just, as we move along over time, our values do change, and our value to money changes, and work, like I mentioned death before, and I think that it is extremely important, because if you know that, look, this is what's going to happen to me in a couple of years' time, and I need to now work to maintain this level of income that I want, or a greater level of income that I want and need, then if you know that's something that you can work towards to, and know how values change over time. So yeah, there's lots of information there. You may have to listen to it 2 or 3 times, but if you do want to know more, you can contact me through Radio Kidnappers, or on at stephen@taxile.co.nz, or my number is 021 085 10771, 021 085 10771. So once again, thank you for listening, and thank you to the team at Radio Kidnappers. Bye-bye.